In this module, we will take you through an introduction to and basic overview of the principles of double-entry accounting. Accounts are summaries of information relating to the financial affairs of a business. They are used to help keep track of business activity, profitability, and its overall financial health. Accounts for taxation, reporting, or other purposes are often prepared on the basis of a company's accounts. It is therefore essential that efficient and accurate accounts are kept. Double-entry accounting is a set of rules governing the way which accounts are recorded. It operates on the basis that each transaction has two corresponding entries in the business accounts, one debit or left column and one credit or right column. A series of ledger accounts record the company's transactions, and each credit and debit entry are made in the appropriate ledger account for each transaction. Because each credit and debit entry for a transaction offset each other, when properly kept, accounts will have equal credit and debit balances, giving rise to the phrase balancing the books. This is an example of a blank ledger account. You will see that it is broken into rows and columns. Each row is a separate transaction, and the columns contain the relevant information about that transaction so as to identify the date of the transaction, its nature, the parties involved, and the appropriate debit or credit entries to the value of the transaction. A running balance of each account ledger is kept, updated after each transaction. It is important to note that debit and credit simply mean left and right. An increase or decrease of the balance of an account can be marked either as a debit or a credit,